If it weren't for U.S. administration's soft dollar policy, the buck could be trading a lot higher than it is right now. As far as the big picture goes, we've got a Fed normalizing monetary policy and an inflation outlook in the U.S. easily capable of ramping up at a faster rate than the market is currently pricing. As far as currencies and yield differentials go, these are U.S. dollar supportive developments that also have the potential to fuel more dollar demand, given the implication here, which is higher U.S. interest rates translating to less attractive equity market valuations, translating to flight to safety bids back into the greenback. And so we are seeing a bit of this going on out there at the moment, with that first phase manifesting in the form of U.S. dollar short covering. Many market participants are now booking profit on those dollar shorts built up over the past several months, and this has triggered a wave of momentum back in the buck's favor. Of course, that dollar policy overhang is a new variable that the market is still trying to figure out, which continues to be a major thorn at the buck's side. We think it is going to be important to continue to monitor the price action in U.S. equities. Right now, we are seeing a market that is doing what it has been doing over the past several years, finding bids at every dip before racing to another record high. But as inflation shows signs of working back in, and as policy normalizations push forward, the idea of something different happening this time round is not that crazy, and if we see the market start to roll over after stalling out ahead of the record high from earlier this year, it could very well inspire that massive reduction in risk appetite we believe is long overdue, and something that will be capable of offsetting U.S. dollar weakness from U.S. administration policy, fueling a much bigger push back the dollar's way. Now, we do believe that other major currencies will find bids as well in this type of a backdrop, with the franc and yen absorbing the traditional inflow, and the pound and euro getting some of the diversification flow as well. The pound has been a strong performer over the past several months, and with the recovery looking up, the BOE expecting more rate hikes, and the UK economy operating well historically with a stronger currency, Brexit bumps appear to be the only major drawback to currency appreciation. But we have seen a smoothing out of those bumps into 2018, and this should result in healthy demand into dips from an overdue US dollar rally. We think the 134 to 136 area is now an attractive area to be considering long exposure in the pound. Looking at today's calendar, the UK is front and center with jobs data due. Other notable standouts on the day include Eurozone and German manufacturing data and US existing home sales, before attention then turns to the late Wednesday release of the Fed minutes. That's all for now.